Imagine opening an app to check on your next set of aligners. You are halfway through treatment, maybe 8 months in, and your teeth have actually been moving the way the company promised. You tap the app and nothing loads. You try again. Still nothing. There is no email, no warning, no explanation. The app is gone, the customer service line is dead, and tens of thousands of people are staring at the same blank screen on the same morning, all having paid around $2,000 for a treatment that has now simply stopped existing. That's what happened when SmileDirectClub collapsed. Understanding how a company reaches that point requires going back to where it started. SmileDirectClub didn't launch quietly. It launched with a genuine argument that was difficult to ignore. Traditional orthodontic treatment, the kind involving wires, brackets, and repeated visits to a dentist's chair, costs somewhere between $5,000 and $8,000 depending on where you live. A large portion of the population couldn't afford that, so they lived with teeth they weren't happy with and had no realistic path to changing. SmileDirectClub's pitch was that they could deliver the same outcome for under $2,000 entirely through the mail, without requiring patients to set foot in a dental office. The model worked like this. A customer would visit one of the company's Smile Shop scanning locations or order an at-home impression kit, get a 3-dimensional scan or physical mold of their teeth, and that data would be reviewed by a remote-affiliated dentist or orthodontist working digitally. If the case was approved, a full series of clear plastic aligners shipped directly to the customer's home. No waiting rooms, no repeated office visits, no chair time billed at a few $100s an hour. For younger adults who'd spent their lives unable to afford orthodontic work, it genuinely sounded like a solution that addressed a real access problem in American healthcare. The growth numbers in the early years supported that narrative. The company opened Smile Shop locations across the United States, built a large social media marketing presence, and by 2019 had grown fast enough to list on the NASDAQ at a valuation of roughly $9 billion. The IPO raised approximately $1,350 million, making it one of the larger public offerings that year. The company's core marketing message centered on the idea that they were democratizing something that had always been financially out of reach for ordinary people, and that framing resonated with customers and investors alike, at least through the early phase of the company's public life. The warnings, though, had been arriving since well before the IPO paperwork was filed. The American Association of Orthodontists began filing complaints with state dental boards in 2016. 2 years after SmileDirectClub launched. The concern was not about the price point or the business model in the abstract. It was about the clinical process. The standard of care for orthodontic treatment includes in-person physical examinations, x-rays to assess root health and surrounding bone, and ongoing monitoring as teeth move under pressure. SmileDirectClub's model omitted most of that. A dentist reviewing a case remotely was working from a digital scan and a set of photographs, without x-rays, without a physical examination, and without any mechanism to assess conditions that would not be visible on a surface-level digital image. The company's response to those early warnings was to grow faster and market louder. Complaints from orthodontic associations were characterized publicly as the established dental industry trying to protect its revenue from competition rather than raising legitimate clinical concerns. With the stock rising and the customer count climbing, that argument found a receptive audience. But the cash was burning at a rate the underlying business could not sustain, and the patient safety concerns were not disappearing just because the marketing budget kept expanding. By the time SmileDirectClub was trading on Wall Street, customers were already documenting serious problems in public forums and regulatory complaint databases. The issues being described were not minor fit problems or slower than expected progress. People were reporting permanent changes to their teeth and jaws that had not existed before they started treatment. The complaints documented across regulatory agencies and consumer platforms in 2019 and 2020 described bite misalignment, where the upper and lower teeth stopped meeting correctly after treatment. They described tooth root resorption, a condition in which the roots of the teeth actually shorten because pressure was applied incorrectly. Patients reported gum recession and nerve-related symptoms that persisted after their aligner courses ended. To understand why those outcomes were occurring, it helps to look specifically at what the remote screening process left out. Before a licensed orthodontist applies any corrective pressure to a patient's teeth, the standard clinical process requires X-rays to evaluate root health and bone density, a complete in-person examination of the bite, gum tissue, and jaw alignment, and a treatment plan constructed around the actual anatomy of that specific patient's mouth rather than a surface-level digital impression. SmileDirectClub's affiliated dentists were reviewing cases without X-rays, without physical access to the patient, and with screening criteria that were not designed to reliably identify the cases where aligner treatment without in-person monitoring created meaningful clinical risk. Patients whose cases fell outside the safe range for this kind of treatment had no reliable way to know that before paying and starting. The FDA response came in 2021 in the form of a formal warning letter to the company. The agency determined that SmileDirectClub's at-home impression kits, the physical molds customers used to initiate their treatment from home, were being sold and distributed as medical devices without the regulatory clearance process that would have required the company to demonstrate their safety and effectiveness before shipping them to consumers. That determination covered a product that had already been sent to hundreds of thousands of homes across the country over several years of operation. The clearance process the FDA was pointing to exists precisely to evaluate whether a device being used to initiate medical intervention on patients poses risks that have not been adequately characterized, and SmileDirectClub had been distributing these kits at scale without completing it. SmileDirectClub's legal and regulatory response was to push back rather than pull back. The company argued that its model was operating within the law and that the regulatory frameworks being applied to them were instruments of industry protectionism rather than legitimate patient safety mechanisms. When the state of Alabama moved to restrict their operations through specific legislation, the company filed a lawsuit challenging the restriction. They lobbied simultaneously against dental board oversight in multiple states, coordinating legal and political strategies in parallel, and framing every regulatory challenge as a competitive attack mounted by the traditional dental industry rather than a response to documented clinical concerns. The litigation that followed added significant financial pressure to a company that was already burning capital at an unsustainable rate. Lawsuits were filed in multiple states by customers alleging permanent dental damage as a direct result of their SmileDirectClub treatment. The Better Business Bureau complaint volume for the company reached levels among the highest recorded for any consumer health business operating during that period, and a substantial portion of those complaints described physical harm rather than service or refund disputes. Adding to the legal complexity was a liability structure that most customers were not aware of when they enrolled. The dentists who reviewed cases remotely were affiliated with SmileDirectClub through a contracting arrangement, but the malpractice exposure for adverse patient outcomes was deliberately structured in a way that made clear accountability difficult to establish after the fact. When something went wrong, the company directed responsibility toward the affiliated dentist. The affiliated dentist's professional liability coverage did not clearly extend to remotely supervised SmileDirectClub cases administered without in-person examination. Customers who pursued legal remedies found themselves navigating a structure that had distributed responsibility in every direction without assigning it cleanly to anyone. Every dollar the company spent defending that structure against regulatory challenges and civil litigation was a dollar it could not direct toward the customer acquisition engine that the entire business model required to function. The stock had been telling this story before most people were willing to say it plainly. SmileDirectClub opened on the NASDAQ in September 2019 at $23 a share and never sustained that valuation. The share price declined steadily through 2020 and 2021 as institutional investors looked more closely at the financial mechanics behind the growth narrative and found that the numbers did not hold together. The company was losing money at scale, and the losses were not the kind generated by productive investment in technology or infrastructure that would eventually produce returns. They reflected a customer acquisition cost that consistently exceeded the total revenue any individual customer would ever generate over their relationship with the company. That is a structural problem, not a cyclical one, and no volume of new customers could fix it, because signing up each new customer made the financial position incrementally worse rather than better. Between 2019 and 2022, SmileDirectClub burned through roughly $1.4 billion in cumulative losses. That figure spans 3 full fiscal years and represents sustained operating losses with no credible plan on record to reverse the trend. The $1.35 billion raised in the initial public offering went largely into marketing spend and geographic expansion of the SmileShop scanning network rather than into clinical infrastructure, product improvement, or building the kind of operational efficiency that might have eventually produced a profitable unit of business. Customer counts kept climbing, which produced quarterly headlines that sounded like progress, while the underlying economics of each new customer relationship made the company's long-term position worse. The COVID-19 pandemic in 2020 exposed how structurally fragile the business actually was. The SmileShop scanning locations, which were the company's primary channel for onboarding new customers, closed almost immediately as public health restrictions took effect across the country. Customer acquisition collapsed practically overnight, the new patient pipeline dried up, and hundreds of employees were laid off within months of the shutdown's beginning. The at-home impression kit was the logical alternative channel for reaching customers who could not visit a physical location, but that product was also the one the FDA had flagged as lacking proper regulatory clearance, so leaning harder on it created its own compounding exposure. The years after the pandemic became a slow-motion search for a version of the business that could survive the simultaneous pressure of depleted capital reserves, active regulatory proceedings, accumulated litigation across multiple states, and a customer trust deficit that additional marketing spending could not meaningfully reverse. Leadership changes, headcount reductions, and operational consolidations followed in sequence, each framed publicly as a step towards stabilization. New executive leadership arrived in early 2023 with messaging about a turnaround effort, but by that point, the debt load was too heavy to refinance on commercially reasonable terms, and the customer acquisition engine that the whole model depended on had lost the credibility needed to drive volume. Any potential strategic acquirer conducting standard due diligence would have encountered the liability exposure embedded in the existing customer base and the active litigation docket. In September 2023, SmileDirectClub filed for Chapter 11 bankruptcy protection, listing roughly $900 million in debt and approximately 400,000 active customers who were somewhere in the middle of their treatment plans on the day the filing became public. Chapter 11, bankruptcy, is designed to give a company the ability to restructure its obligations and continue operating in a reduced form while the courts sort out creditor claims. SmileDirectClub's Chapter 11 became something different. Within weeks of the filing, the company shut down all operations entirely rather than attempting any form of reduced-scale continuation. The app went offline, customer service lines stopped connecting. The network of affiliated dentists that had been remotely supervising active cases dissolved because there was no longer a company maintaining those contracts or processing payments to the providers involved. Customers who were partway through multi-month treatment plans, some on their 8th aligner out of 22, others further along, were left at whatever stage they had reached on the day the company closed, with no transition protocol, no clinical handoff to an alternative provider, and no direct communication from the company explaining what their options were. Dental professionals who commented publicly on the abrupt shutdown were consistent in their clinical assessment. Stopping aligner treatment partway through a course produces real and measurable consequences for the patient. Teeth that have been moving under sustained pressure from a series of aligners will migrate back toward their original positions once that pressure is removed and no subsequent aligner is applied. The rate and extent of that regression varies by patient, but the direction is predictable. Some customers were left with their teeth in an intermediate position past their starting point, well short of the intended endpoint, with no straightforward path to completing a correction that had already been partially made and paid for. The standard recommendation from orthodontic professionals was to schedule a full clinical examination with a local orthodontist and begin a new treatment assessment from scratch, which for many customers meant paying again in full for work that SmileDirectClub had already charged them for and failed to complete. The bankruptcy court became the primary venue for customer claims once the operational shutdown made all other channels unavailable. Thousands of individual creditor filings came in from people who had paid the full treatment cost up front, received some portion of their aligners, and received nothing further after the company shut down. Under bankruptcy law, these customers were classified as unsecured creditors, which placed them at the back of the repayment sequence behind secured lenders and bondholders, the financial institutions that had extended credit against company assets collected first. Individual customers who had paid $2,000 for an incomplete course of treatment competed for whatever remained after senior creditors were satisfied, and in this case, that remainder was minimal for nearly everyone filing a claim. Court documents filed in the months leading up to the bankruptcy showed executive compensation continuing to flow during the period when the company's financial position was actively deteriorating. Co-founder David Katzman had drawn substantial compensation across the company's operating life, and the capital structure of the business gave certain stakeholders financial protections that retail customers never had access to. Investors and lenders with secured positions had contractual mechanisms to recover partial value from the dissolution. Customers who had paid for a healthcare service had no equivalent protection and no priority, standing in the creditor queue. State attorneys general in multiple states opened investigations following the shutdown, and consumer advocacy organizations pushed for federal-level intervention. But neither track moved quickly enough or reached broadly enough to produce material recovery for the people already stranded mid-treatment. The bankruptcy process has well-developed tools for resolving financial obligations between institutional creditors. It has no mechanism for completing interrupted dental treatment or compensating patients for physical outcomes that a check cannot reverse. By the time the proceedings concluded, the recovery rate for individual customers on their out-of-pocket payments was, for the vast majority of claimants, effectively zero. The teeth were wherever the treatment had left them. SmileDirectClub raised over $1 billion from public investors, collected payments from hundreds of thousands of customers, promising them access to orthodontic care they could not otherwise afford. And when the business failed, the customers who had paid in full and received the least were the ones at the back of every repayment line. The company operated in a regulated healthcare industry, pushed back against clinical oversight at every stage, and the physical consequences of that approach outlasted the business itself. Thanks for watching. Feel free to subscribe if you want to watch more videos like this.